If your wallet looks thin and you're constantly worried about making ends meet but your dreams are big, filled with visions of financial freedom and success, you're a margin trader in the making. Margin trading can be your gateway to achieving those dreams. Margin trading is like borrowing money from a friend to invest in the stock market, but in this case, the friend is your broker. Here's how it works. You put up some of your own money, called the margin, and borrow the rest from your broker. You put up some of your own money, called the margin, which acts as a security deposit, and borrow the rest from your broker. This borrowed money allows you to leverage your investments. This allows you to buy more shares than you could with just your own cash, potentially increasing your profits, than you could with just your own cash. However, this also means you are taking on more risk. But remember, it's not free money. You'll pay interest on the borrowed funds just like any other loan. You'll pay interest on the borrowed funds, and this interest can add up quickly, eating into your profits. And if the stock price drops, you could end up owing more than you initially invested. You'll owe more than you invested. High risk, high reward. To start margin trading, you need to understand these risks. You need a margin account with your broker. They'll have specific requirements like a minimum balance, which is essential to maintain, known as the maintenance margin. This is the minimum amount of equity you must maintain in your margin account. If your account falls below this threshold, your broker will issue a margin call. You'll get a margin call. This means you need to deposit more money into your account or sell some of your assets. This means you need to deposit more money to bring your account back up to the required level, or sell some assets to cover the difference. This can be stressful, especially if the market is volatile. So why do investors use margin trading? It amplifies both gains and losses, making it a double-edged sword. It amplifies both gains and losses. If the stock price goes up, you can make a lot more money than you would with just your own funds. If the stock price goes up, you can make a lot more money. This is the allure of margin trading. You can make a lot more money, but remember, the reverse is also true. But if it goes down, you can lose a lot more too. This is why margin trading is considered high risk. You can lose a lot more too. The potential for significant losses is real and should not be underestimated. In summary, margin trading can be a powerful tool, but it's not without risks. Always do your homework and understand what you're getting into, but it's not without risks. Always do your homework and consider your risk tolerance before diving in. Consult with financial advisors if needed, and consider your risk tolerance before diving in. Happy investing. May your financial journey be prosperous and well-informed.